Hello everyone, my name is Greg Tomkins of Tomkins Financial, and today I'm going to show you how changes in interest rates impact the real estate market. Now remember, there are many different factors that impact the real estate market. So in our example, we're only going to look at what would happen if mortgage interest rates changed, but all of the other factors stayed the same. This is so we can highlight the individual impact that interest rates have. Let's start with some data. In 2018, the Canadian median income was $71,011. Current 5-year fixed mortgage interest rates are around 2.75%. When lenders determine how much you can afford to borrow, they look at what your monthly payments would be, not necessarily what the total value of your mortgage is. So in this example, this family can afford a $2,400 per month mortgage payment. Now remember this payment number because it's important. With a $50,000 down payment, this will qualify them for a $551,000 house. Now let's see what happens when interest rates drop, a situation that's been happening in Canada for the past 30 years. If we assume mortgage rates drop 1% to 1.75%, this family can still only afford the exact same payment of $2,400 per month. However, because their interest rate is lower, they can now qualify for a larger mortgage, which equals a bigger house. With the same $50,000 down payment, the family can now afford a $611,000 house. That's an 11% increase in the value of house they can afford. Now let's just assume the average family represents 50% of Canadians. I know this isn't true, some make more, some make less. It just makes the example easier to understand. If we have 50% of the population now able to afford 11% more house, what do you think happens to house prices? That's right, we pay more and house prices increase to match the new amount of money available. Let's go the other way now. What would happen if mortgage rates actually rose 1% to 3.75%? Well, the average Canadian family can still only afford the exact same payment of $2,400 per month. With a $50,000 down payment, this qualifies them for a $510,000 house, a decrease of 7.4%. If 50% of the population is now only able to qualify for 7.4% less of a house, what happens to prices? Prices should drop as there is less money available for purchases. I'm Greg Tomkins of Tomkins Financial, and thanks for listening. If you have any questions, please feel free to reach out and I'd be happy to answer.